A bond is simply debt taken on by a company or a government agency to fund projects, much like you would borrow to buy a house or finance a car. The Fed, being near the end of its tightening cycle, is a game changer for fixed income by restoring its value. So what does this mean now for specifically investment-grade corporate bonds, and why should we pay attention right now? We're going to find out today, right here on UBS Trending. Hello, everyone, and welcome to another episode of UBS Trending. I'm Anthony Pastore. Thanks for joining us today. My colleague from the Chief Investment Office, Barry McAlinden, is here to get down to what's important right now when we're talking about investment-grade corporate bonds. So, Barry, good to see you. Thanks for coming by. It is a really good opportunity for investment-grade corporate bonds, as I read in a recent report that you put out. But tell our audience why. What makes them so special and so hot right now?
Well, it really comes down to the yield that's available on the asset class, and the yield is derived mostly from the work that the Fed has done in raising rates. So we know Treasury yields have come up, quite a bit, and that's the bulk of the yield that you can get for investment-grade corporate bonds. Is about 80% comes from Treasuries, and about 20% from the additional credit spread in the asset class. But this yield really represents, your return potential. It's the coupon income that you're getting. As well as the prospects for your returns going forward. So the value's been restored, and it's like going shopping. We have a lot of different options to choose from. Not like during the pandemic when there was only limited items on the shelves, and you had to take what you can get. Now. With rates really what they are, fixed income investors are kind of re-engaging the asset class.
Right, we were talking about that right before we started, and we were saying it wasn't unlike going to the grocery store in those early months of the pandemic when you really could only choose from maybe one or two brands of sliced bread, where you go to the store now and there's probably 50 of them on the shelf. So sort of similar to what was going on with corporates in those days.
That's right. That's right. Yeah, and we went through extensive periods of time, especially after the global financial crisis, where the Fed had rates at zero. So even though corporates were giving you a spread, they were still kind of in a lower range than you were used to, certainly, if you had been familiar with the asset class from kind of the early 2000s. So the yield value now is about 5.5% for investment-grade corporates on average. And that's more like the yield, that we got in the early 2000s.
Right. So it's almost at historic levels at this point.
Right.
So when you talk about specifically dialing down a little bit for those who may not be as familiar with IG corporates, a little bit of a 101. A lot of times you do talk about the spreads, whether they're widening or they're tightening, and how it ties into obviously what the Fed is doing, where Treasury rates are. When we talk about a tightening spread or a narrowing of the spread, that typically means we could potentially be going into a more positive economic cycle. Is that what you're seeing right now?
The spread is on the tighter side, so it's not factoring in a really bad economic environment. In addition to fundamentals, spreads also react to what we call technicals. That's supply, demand, and there's been a lot of demand for investment-grade corporates. You see that evident in fund flow data. As well as primary market activity. So, could spreads grind a little tighter? Perhaps. But we actually think, they're more likely to turn the other way, especially, later this year if we do see the economy, weaken a bit more, maybe later this year than earlier this year. But again, I think the magnitude by which the spreads would increase we think should be more limited to what you typically see in a recessionary environment. And, given just the fact that these companies are have the balance sheets, to kind of just withstand, both the economic uncertainty, but also, the increase in costs, right? By their nature, if they're debt issuers, they're paying interest, they're borrowing on the balance sheet. Costs have gone up. But they're diversified, their business profiles are definitely large enough that it's less of an issue for them.
Yeah, and when people, obviously when we're talking about the fixed income side of the market, people hear corporates and they might automatically go, well, listen, on the equity side, looking at the stocks of these companies, especially there's been some general underperformance in fourth quarter earnings, and even the guidance is looking a little rough. That doesn't always go hand in hand with what's happening on the bond side, right?
Exactly. It doesn't always go hand in hand, for For the bond side, you're looking at companies to kind of be not overly aggressive in their balance sheets. So, and investment grade companies, can control to a large extent how much leverage they take on. Usually it's acquisitions when you see them taking on the most amount of debt. But it's within their control, and they have the ability to manage that more conservatively.
And what about cash flows right now in these companies? Is it looking pretty strong for the most part?
It is, yeah. Cash flows are quite strong. So you're looking at strong cash flow environment. They're covering their interest costs, and to your point, you don't necessarily have to rely on the growth. Even though our colleagues on the equity side and CIO, expect S&P 500 company earnings, right, to be down this year. That's okay from the credit point of view. Again, as long as you're not seeing companies' balance sheets that weaken too substantially.
What about duration? Do you think that we should be that investors who are certainly looking into the IG corporates, do you think that they should be looking more at taking some duration exposure within the asset class? Yeah,
so especially with Treasury yields now having come up during the month of February, we do think that you can take incremental duration.
Right.
With the 10-year, kind of in that 390 upper end of the range that CIO had been looking for. And that said, we also like the short end because the yield curve, you can see on the chart, it's pretty flat. So you're getting that 5.5 to 5.6% yield all the way from very short maturities of just 1 to 3 years, all the way out in intermediate. So kind of having a barbell of both, the short end as well as intermediate. And I think with the big difference is that those intermediate maturities, they do give you the ability for some price appreciation if yields eventually go down. And we think that's actually the path that's most likely over a longer time frame later this year, based on some of the slowing effects from the Fed's tightening comes into play. And Treasury yields usually react by moving lower in that environment. So that can be an additive part of the return that you'd get more from those intermediate maturities than you would from the short maturities.
Yeah, and that actually brings up a really good point, Barry, because we're looking at especially the central scenario right now coming out of the CIO for the 2023 outlook is that major central banks, including the Fed, the ECB, the Bank of Japan, that they will be completing their hiking cycles sometime in the first half of the year. I think as of right now, CIO expects 2 more rate hikes by the U.S. Federal Reserve in March and April. But they're unlikely to maybe cut before the end of the year. And I was talking to Salita Marcelli, our CIO. She said maybe even pushing a little bit further into 2024. Does that impact your outlook for IG corporates? Is it, in other words, could the spreads maybe widen a little bit based on the trajectory of the Fed?
Well, I think, one question we're getting asked a lot is why not just stay on the short end within IG corporates? And one of the disadvantages on the short end is that reinvestment risk. When it comes due, you have to reinvest sooner. Now, if the Fed does stay at these higher levels of rates longer, investors will have the ability to reinvest at those higher rates. Perhaps, which is something, again, they haven't been accustomed to because we had the situations during the pandemic when the Fed had the emergency cuts to zero. Right. Before that was the financial crisis. So it looks like these yields could persist. I think that's something that investors would consider. But certainly, yeah, longer term with the Fed, having kept rates at these higher levels, we're going to just have, continue to monitor, I guess, the stress that's felt within certain companies. And I think, again, this points to the benefit from the investment grade cohorts where they should be able to navigate, that stress and funding costs a little bit better than their colleagues, in the high yield market.
Right, terrific. Hey, Barry, listen, as you said, it's a 5% yield right now, certainly attracting, as you said, new investors to the market. And, got to get out there before the inventories run low again, especially as hot as the market is right now for IG corporates.
Yeah, it's certainly an exciting time. Yeah, and fixed income again.
Yeah, exactly. Great. Barry, thank you very much. Good to see you. And there's a lot more information on what Barry and I talked about. You can take a look at our UBS House View at a glance or the recent Fixed Income Strategist, where there's a whole section on investment grade corporates that Barry wrote. So you can take a look for all of that by going to our insights page at ubs.com/views. And make sure to follow us on social media, Instagram, LinkedIn, Facebook, Twitter, plus all of our past UBS Trending episodes are available for you right now on demand on ubs.com/studios website and on the YouTube channel for UBS. And if you have any questions about your portfolio or wanting to incorporate some of these IG corporates into your portfolio, make sure to talk with your financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.